Hi, this is the Business Guy. As you know, Silicon Valley Bank collapsed last week, and I'm going to tell you why. There's two reasons. Number one, you need to understand this about their bank. 93% of their customers had over $250,000 in the bank. So the vast majority of these customers in that bank were hedge fund managers, venture capitalists, tech startups. So they were not mom and pop, and that's not who they catered to. So to put it in perspective, with FDIC insurance, the insurance fund, which comes from banks paying insurance premiums into the fund, covers up to $250,000 of your deposit in the event of a bank failure, okay? So the typical bank, 75 to 80% or more of the depositors, or up to 90%, have less than $250,000 in the bank. So the typical bank covers 75 to 80% to 90% of the deposits. In other words, most of the people at Silicon Valley Bank are rich people with $500,000, $1 million, $20 million at this local bank. But most people at most banks have under $250,000. So this bank was the inverse of that. So at Silicon Valley Bank, north of 90% of the deposits were not covered by FDIC. And it's silicon, by the way, that's the black substance that tech companies use for computer chips. Silicone is used in breast implants and to caulk the tiles around your bathtub. So it's Silicon Valley Bank. So back to our story. That means there were a bunch of multi-million-dollar customers sitting at that bank. So these were the players, and they got caught. Okay, and I'm going to tell you how they got caught and what the bank did wrong in just a bit. So this is what happened. And by the way, this should not affect your local bank at all. It almost has nothing to do with your local bank. It's a bunch of Silicon Valley tech startups and venture capitalists from all over the place, so your bank is safe with near certainty. Silicon Valley Bank was the 16th largest bank in the United States with over $200 billion under deposit. Though this bank was for venture capital throughout the tech industry and served as a hub for thousands of businesses around the country, banks don't just take your money and throw it under a mattress. Instead, they invest it, and in this case, about a year ago, Silicon Valley Bank took $100 billion and invested it throughout government-backed bonds and maybe a few mortgage-backed securities, with a significant portion locked away for 3 to 4 years at an average interest rate of just 1.79%. Essentially, this means that Silicon Valley Bank had all of their customers' money, but it was illiquid. And in the event that a lot of them wanted their money back at once, they'd be in trouble. Now, when anybody and their grandma can go on the Fed's website themselves and buy US government bonds that pay 5% per year, and this bank has invested in long-term bonds averaging 1.79%. And by the way, their $100 billion in bonds they had at 1.79% would produce $1.790 billion in income for the bank per year. So that's a ton of money. The problem is, if the bank needed cash in a flash to fulfill above average withdrawal requests, they would not have the money to do so. And that's exactly what happened. There was an announcement on social media that the bank did not have enough liquidity to meet withdrawal requests. The CEO and other board members were selling off large portions of their stock in the bank, so the Fed had to come in and take over the bank and meet the shortfall until the 4 years pass when these bonds come due. As a result, we've just witnessed the largest banking bailout since the great financial crisis, with a new plan that would completely backstop losses and provide near infinite money to the banks in need. Although for some, this still might be too little too late. After all, regional bank stocks have already just taken their largest single-day losses in history, with customers continuing to take out their money, and lawsuits are beginning to emerge throughout the banking industry. And the rumors are circulating that the Fed may have no other choice other than to pause the rate hikes in the near future in an effort to restore faith in the economies. And keep in mind, the safest banks in the world are not in the US, contrary to common belief. If you look at the list of the safest banks in the world, only 4 of them are in the US, and they're on the bottom half of the list. So out of the 50 safest banks, only 4 are in the US. And these 4 safest banks in the US are all little regional farming banks. So none of the major US banks are on the world's safest banking list. They're in Switzerland, Luxembourg, and other countries where banks are operated very conservatively and not this multi-leverage thing that the banks in the US do. So that's what happened. Please like, subscribe, put your comments below. This is the Business Guy.